Hello there. I'm going to be talking about some of the differences between 15-year mortgages and 30-year mortgages, a few different factors. Well, first question is, what are the economic factors that drive the 15-year mortgage rates? It's really not that much different than the 30-year, a rate essentially based on prime rate. However, generally the 15-year mortgage is a lower interest rate because the bank is obviously taking on less risk by getting more of the loan paid back sooner. The difference, I don't know, it ranges, but on average it can be around a percentage point difference. So in our current rate market, a 30-year might be 6.5 and a 15-year could be 5.5, give or take maybe a quarter point. Just in general, the pros and cons of the 15 versus the 30 are that, the 15, while it comes with a lower rate, you're paying back the loan twice as fast. So your monthly payment is going to be higher even though the interest rate is lower. And with the 30-year, you're going to pay more interest over time because you're in the loan longer. However, the monthly payment will be less. I personally would go, in my experience, have gone with a 30-year mortgage always, mainly because even though I could maybe pay the 15-year mortgage and do that, I would want the flexibility to make less of a payment at any given time that I want. So I could choose to pay a 30-year mortgage in 15 years, and it would, be roughly the same, or not the same, but similar. So I just think the 30-year, the benefit is the flexibility of the lower monthly payment. Obviously, if you can't afford the higher monthly payment, you're going to go with the 30 anyway. That's the standard mortgage, and if you're doing it for investing, obviously you want to generate as much cash flow usually as possible, and if you're doing a 15-year mortgage, you're going to be more out of pocket on the monthly payment, therefore your cash flow would be lower. So the difference really is only the rate difference and the timeline you pay over, which affects the monthly payment, and you really just have to factor that, those three things into your decision-making process. There's some questions here about what borrowers can do to improve their chances of securing a 15 or 30-year mortgage, and to improve, the rate or whatever. Ultimately, you just need the income level to support the loan. And of course, the property has to appraise at the right value for you to get the loan amount that you want. Otherwise, if you need increased income to get the loan, you could do things like get a cosigner. You could house hack and have a tenant. If you're buying a multifamily, you could live in one and rent out the others and use the rent as increased income to qualify the loan and things like that. In terms of rate differences people can expect on the application process, usually the rate that is posted on the website or on the internet is based on excellent credit, which is usually at least 720 or higher, but I think often even 750 or higher. If your credit is lower than that, the further down your credit goes, the higher your interest rate will go. So that's one of the reasons it's so important to maintain your credit score and be very careful about keeping it in good shape, because it will be the reason you do or do not get a loan, and if you get a loan, it will seriously affect the interest rate and hence the total interest you pay on the loan. So there you go. There's some thoughts on that. I will see you in the next video. Thanks.